Hey everyone, this is the Trader Investor again. For this video, as promised earlier today, I'm going to go over order blocks and imbalances. And as we find trails smart money is leaving behind for us to trade, I want to show you what imbalances are and how those get covered as well. So it's important as we are building on to the learning, right? Every week we are learning something new, we build on that, and we combine everything that we learn to trigger our entries. That's a key part. That's why I keep adding on new ideas, new theories, and new strategies for us to keep building on. And so let's focus on order blocks and imbalances, and make sure you look at the previous videos that I did on demand zone, supply zone, order block. That's a very important video. It goes into full details. Today we're not going to go into the detail on order blocks. We will do a couple of them. We will identify a couple and draw them out. But then I want to go into imbalance, and then I want to go into how we enter our positions, long or short, based on the order blocks and based on the imbalances that we see. And once you understand imbalances, then it will make sense on how we are executing our entries and our exits. So that's the key part for today. So starting point, always is save. What is the market structure? Is it in an uptrend? Is it in a downtrend? Or is it consolidating? Is it sideways? Consolidation, sideways, is a term that most retail investors, retail traders are aware of. But really what they are is an area of accumulation and an area of distribution. Institutions, banks, as they are trading, they find areas where they want to accumulate more. That's why it's called accumulation. After price gives them an entry point that is favorable to their likings, to their advantage, they will accumulate positions. And then as price moves away from accumulation and it gets to an area where they are done accumulating and they want to take profits, it's an area of distribution. Usually what happens is, in an area of accumulation, retailers, out of FOMO, they will keep thinking, oh, price is going to keep going down, it's going to keep going down, and they will keep selling, and they get trapped in the sense that their positions will be wiped out with their stop losses. And if they're not managing their positions properly, then they blow up their accounts because they're on the wrong side of the trade. Same thing happens on the distribution side, as retailers, out of FOMO again, want to keep buying because they have missed all this big move and they think that there's this much move again coming up for them. So they take those positions and they get stopped out as well, because what institutions are doing is they're dumping those positions. Whether it's FOREX, stocks, futures, it doesn't matter what asset class you're talking about, crypto, real estate, it could be anything. When those who believe that there's no more growth, or they're done growing and they want to take their profits, when that large amount of positions are dumped, then price has nothing else to do but go down. And then once it goes back down, they come back and accumulate again. They come back and sweep up all those positions, all those sell orders from retailers, and take the price back up. So that's why structure is important to understand. And then for us, before we enter, we have to also understand what is area of value. Area of value means, in a structure, is price giving us an entry opportunity? We never want to chase. if price is going to continue to go up, we don't want to buy at the high. We want to buy when there's a pullback, and then on a lower time frame we find that break of structure of that pullback and we enter long. And vice versa, on a downtrend we want a rally, and when that rally structure breaks we want to enter short. So that's why we have to identify area of value. Structure, area of value. The last thing is execute. If we understand structure and area of value, it's easy to execute. Without that, we're executing out of fear, greed, out of ignorance. So we have to really manage how we are trading, and we have to trade smart. So that's why it's critical to understand SAVE. This is my anchor always. This is where I start, and I talk a lot about structure. His structure, his broken structure, his entry, his area of value. In all of my videos, you hear me mention those words multiple times. So in today's conversation, as we're talking about order blocks, zones for areas of values, and imbalance, we want to understand why some support and resistance work better than others. Retailers will draw a line because that's the most common thing we learn as technical analysis: support, resistance, trend lines, and then based on that we want to enter. But sometimes they hold, sometimes they don't, and because we don't manage our positions well, when they hold we make very little, when they don't hold we lose a lot. So in order to avoid this, is we want to get an edge. We want to understand where institutions, smart money, banks are positioning themselves, and we want to just follow those positions. With that kind of positioning, we can have higher confidence for our entry, higher confidence to wait for price to move in our favor. Price could fluctuate, can have some volatility, but we have the proper entry, the proper stop, and we wait for price to give us our target one. We don't prematurely exit target one unless we see a break of structure. A break of structure tells us, well, we had the right idea, but the market wants to do something different. On a trade by trade basis, we have no idea what the market will do. We have no idea what the institutions are going to do next. The very next second after I enter a position, I have no idea and have zero control over what the market does. I only control where I will put my stops, how much of my capital I risk in one position, and how quickly I'm willing to exit a trade, whether on the winning side or the losing side. So if we can understand this, and then focusing on the order blocks, which are very, very significant support and resistance. So in an uptrend, there is a bearish order blocks. Those act as resistance. In a downtrend, bullish order blocks act as support. And those are complemented by demand zone and supply zone. I'll remind you again, please refer back to the other video on demand zone and supply zone, because it's a critical video that shows you how to understand. And I'll briefly touch on it just momentarily. So once we understand demand zone is where we accumulate, supply zone is where there's distribution, and so we want to focus on those areas depending on the trend we're in. If we're in a very strong downtrend, we want to come up to some distribution area and go back down. If we're in a strong uptrend, we want to come down to an accumulation area, go back up. So that's will be our focus. And let's define a couple of those terms. Demand zones are areas of consolidation before price makes a wild move to the upside. An impulsive move to the upside preceded by a consolidation, that's a demand zone. It just tells us that there's a lot more demand than supply in that area. And on the reverse side, supply zone are areas of consolidation before price makes an impulse move to the downside. So that wild move says there was a lot of supply, very little demand. So the supply side is losing per se, because nobody wants to take those positions, so they have to keep selling at a lower and lower price. And an bullish order block and bearish order block are just areas where institutions will drive the price in the opposite direction of where they want to go. So they start with a bearish bar before they take price bullish, and vice versa. They take a bullish bar before they take price bearish. So those were the terms that we discussed in the prior video. This is so in a bullish order block, the way we identify the block is the last bearish candle before price starts to take out highs, and a bearish order block is the last bullish candle before price starts to take out lows. And an imbalance is then the excess of buy or sell orders that are not resolved. Meaning, when we have consecutive buys and bars are just making higher highs and higher lows, even on a bar to bar basis, and no wicks fulfilling the sell side, everyone is just buying, and only those taking profits or selling at that price are fulfilled. But anyone who wants to go short, for example, at that particular price is not fulfilled, because there's just not enough demand for that position. So everyone just keeps buying and taking the price up, and so an imbalance occurs. This will make sense when we see it on the chart. And when there is this imbalance, that imbalance has to close. And many times they will come back and close that imbalance. At least 50% of that imbalance is closed, sometimes more. So this is the general context of the theory that we want to go through today. And finally, just on the demand zone and supply zone, I mentioned this clearly earlier, and Wyckoff is also a very good analysis to add to our supply zone and demand zone understanding. When we see accumulation, that's demand zone. There's the volume of demand is much greater in the accumulation phase, and price is going to go up. And the supply zone is the volume of supply is much greater than the demand, so price is going to go down. And so once we get all of this now together, this is where we have our precision, very precision based entries. Precision based means our stops are very narrow because we're so confident that we have entered at the right place. And if that is wrong, then we're okay to get out of that position with very little loss. Because what we want to do is take a position that will give us at least twice our risk, if not more. So when you hear me say make 2 to risk 1, I always recommend to risk about 1% of your capital as a risk in any one position. So that means you're risking 1% to make 2% of your account. So as you repeat that and as you compound that, it's a significant move in your account. So that's our starting point, is understanding all of this structure, and understanding how things are moving is the biggest part of our analysis. So let's start with some examples and see how it plays out as we move forward. So what I have done is I took just one pair, Canadian dollar versus Japanese yen, and I already drew out a few order blocks. And if an order block has been mitigated, I have removed it, so we only see here order blocks that are not mitigated. And I have not gone into imbalance yet, because before I draw imbalances, I want to explain to you how they're drawn and how they come about. And we will start with a couple of the recent ones, because that's what makes sense. So and when I see the first one, so here's the first one. So this bar on the hourly Canadian dollar Japanese yen hourly January 12th 2021 bar, this price made a low of 81.60 and after that price has just been going down. So the next bar price went all the way down to 81.51, and the following bar's high is 81.52.8. So between this bar high, between the 1700 bar high and the 1500 bar low, there is no price movement. There's a big gap there. Price has just gone down, but nothing has reversed. So this is what is called an imbalance. Price, if you look at price, there's always, so this is an imbalance. So if you see any other bar, there's between wick and wick, between 3 bars, every other bar with 1 bar in between wick and wick, there is no gap. They're always fulfilled. There is no gap. There's always fulfilled. So here you see one gap here again. So let me not draw this one, because what happened to this bar is when price comes down, that gap is filled. So since we have this one very close to it as an example, I think this is good enough. So this bar went down, and as you can see, the first thing that happened was price filled that gap, as I said earlier, at least 50%. They want to take care of at least 50% of that gap. So at 50%, whoever wanted to go short at this 50% would have made a few pips. That's not the suggestion of this training. I am not saying that's what we're going to do. I will go into entries in just a moment. I just wanted to explain to you, when there's a gap, at least half of that gap is filled. And in this parallel drawing that I have in TradingView, I am able to see that 50% line, because that line is automatically drawn for me. So if I go into the settings, I can choose the colors. I can say show the middle line, and that middle line is 50% of that gap. So that those gaps are filled. So that's what I mean by imbalance. And so here, as price went up, as price went down, I am not seeing. So here this was one, but this was fulfilled here. So I'm not seeing anything yet. And this is a replay, so as we move forward, this is where these imbalances are going to make sense, and where we are going to understand what to do with them. So here, for example, here's another one between here and here. So as price went down, but it immediately, in 2 hours, it took care of that imbalance. So imbalances have to be taken care of. So it took care of that imbalance. Again, here we have another one between here and here, but that got taken care of immediately here. So very, very short-lived, they get taken care of. I'll just do a couple more to drive this concept. Once this concept is clear, then we'll move on into entries and we'll start playing. So I think I've already done this one. So let's do one more here. Any obvious one? So here, nope. So here's one. Here's one. Here. To here. So wick high to wick low, or wick low to wick high, depending on which side we're going. So here we have an imbalance that has not been fulfilled in the view that we have here. It's possible as price, as the days goes by, that might get filled, but where I stopped it, that is not filled. So I will remove this one because this one is taken care of. And before I draw any more, I'll just show you that I'm leaving this one. And here is our entry and exit. Here's where we want to have the precision. My entry is always based on order blocks. The imbalance I do not use for entry. You can. They work at times if you really understand, and depending on how far away you are from order blocks, because as we get near order blocks, price might just go through them to clear that mitigation. This is a priority. This has to be mitigated. This is just a gap that the other side was not able to get fulfilled. This is where the imbalance is. This is a strong position that institutions and banks are holding, and they're losing in these positions. So because they're losing in these positions, this has to get mitigated. Of course, they don't always get mitigated. If, for example, if they have 4 times the size on the way up, at some point they might just say they're satisfied enough with partial loss and close that position, because the gain on the other side, the hedged position, is much greater. We have no idea why they do it. It's really irrelevant. What we know is this is a very strong area of value. If price comes here, we will take advantage of it. If price decides not to come here, we move on. Right? Plenty of opportunities. So entry is based on our area of value, which is an order block. And entry on order blocks is biased to the long-term outlook of that asset. So in this case, Canadian dollar versus Japanese yen. So because our outlook here is an upward, it is a bullish market. So when price gives us an entry as a test of the order block, this is where we will enter bullish, and therefore our bias is based on that. And then when we come to an order block up above, that becomes our resistance, and that becomes our exit. So we enter at an order block and we exit our final position at an order block. Order block to order block is not target one unless they're very, very close together. Target Target 1 is first sign of trouble, so recent highs. Could be here, it could be here. Now when you're looking at, if I scroll this way, when you're looking at it like here, if you're at this hour, this imbalance is below us, right? So it can't even be a target because this is an imbalance we're expecting price to come and clear to get to this other order block. So I just wanted to make sure that because we're looking at it, on a longer time period, this is not our exit. This does not come into the picture until way down the road. So where this becomes important is if I see, as an example, just randomly, if let's say from a very long time ago, we have an imbalance somewhere here, just randomly. So as I exit my target 1 in first sign of trouble, exit target 2, target 3 as price moves up, I will definitely exit a lot of my remaining positions at a previous imbalance, because when price closes that imbalance, it is likely that it will reverse. Even if it's momentarily, it will go to halfway and reverse, and it could be a strong reversal, like in this case. If this was up here and one did not take profits up here, then price has gone down, way down, and then now we will be forced to take profits. Here we want to take profit. This is our target. This is our happy zone. Down here, we are forced to take profits at a significant lower price. So this is why I want to explain the importance of imbalance. I don't use them to enter. I use them to exit my position when they are at the other side. So in this instance, we're expecting to enter in this order block, but by that time this imbalance would have been closed, so it's not even in the picture. Once we enter into this imbalance, into this order block, this imbalance is taken care of. It's out of the way. So, but if we have a belief that we want to enter short somewhere up here, so it doesn't matter where, if we have a belief that we want to enter short, this could be our first, second, third target, depending on how far away we are when we took that position. So just to be clear, an imbalance that is created as a result of the order block being created is not at play, because when we realize that, we're not even in a position yet. We're waiting for price. We're waiting for price to give us an entry, right? We're waiting for price to do this so that we can have an entry, and by that time this order block will disappear. So very critical to understand this part. So we know how to draw order blocks. If we don't, we'll go back to the other video. Now that we understand imbalance, we combine the two for entry and exit. When price comes to an order block, we enter, and if there is an imbalance left as price was coming down to that order block, we exit at that other side of that imbalance. So that's the part. So now here's where we are. We are at an order block, and if we see a break of structure on the hourly, a break of structure meaning lower highs and lower lows. So we have a high, so the price needs to come, make a new low, make a new lower high, and we can enter to this downside. And if this were to play out as we forward this chart, if this were to play out, is there any imbalance that could be blocking us? So we could see a very, very small imbalance here, very small imbalance. Usually some imbalances I will not even draw if they are so small. Not only that, if they line up with first sign of trouble, so in this zone it's first sign of trouble for me, they line up with that. I mean, one, this is very small, and two, it is in a zone of first sign of trouble. I can just ignore it. This is what I normally do. It's okay if you don't ignore it and draw it. This is just me. And so now let's just, because we are at an order block, I will forward the hourly chart. Once we're away from an order block, we can fast forward on the daily because we want to go a little bit faster. So I will go one by one because I want to see if I get an entry. So here we have a low, a high, higher low, so price could continue to break this upside if it's going down. But the other thing also that is critical is here I want to see a break of structure, not to necessarily enter, but to have my expectation for my entry at the next order block. I don't want to enter a short position when my bias is bullish. When my charts are telling me bullish, I don't want to enter long position, short position. I don't want to enter short position if this happens. I will make an exception at times, and I'll just throw it out here as an example. If I see a retracement past 61.8%, if price goes from an order block, because this is not an order block that is formed, this is an order block from a long time ago. If this acts like a very strong resistance and price breaks the 61.8% retracement, I might enter at that value, waiting for my next bullish trade. So it might be an entry where price will go from 81.06 to 80.63 area as an example in this case. But if I don't see that, I'm not entering any positions. So I'm just playing it out. What I'm expecting to see is another thing also that I will do in this instance is this. We have this low here, we have this high here. So if this high is broken because we kept making higher highs, I might enter a position because my long-term bias is bullish anyway. And a lot of times the reason why I say I might is I want to seek a clear price movement. I want to see upthrust, pullback, upthrust, pullback, but not this up and down movement. So I don't like this price action. If I am wrong and the price goes further up, I'm okay with not entering this position. because I don't like the way price is moving too much sideways. Now, if it gives me a few more sideways movement and acts like a flag, like a bull flag, then I might enter at the high there. So, but for now, it's just a lot of indecision for me to consider. So as you can see, it is now giving us an opportunity to test this order block. So that's something that I want to see. I want price to come into my order block, which is a beautiful, beautiful thing. And I want to see break of structure. And if that break of structure doesn't occur, then that means this was not a strong enough order block, that we're going to test additional order blocks down below. And some order blocks here were already mitigated, so the only one that is visible to me is this one down here in the 80.58 area. This is why I want to do this as a playback, so that my thought process on how I am entering positions is played out. I have not done this study prior to this video. I'm just doing this video as I am thinking about it, as I am coaching you on how I am entering these positions. That's how I'm looking at this video right now. And I see one thing here. I'm not going to enter this, but I see that price has broken the 61.8% retracement. The reason I am not going to enter this is because price has already gone down and reversed, and that is too late. If I had entered earlier, it's something that I might be stopped out, be okay with that, but it's not something that I am willing to entertain. And furthermore, I don't like this very small up move fib retracement. I actually prefer the ones that are much deeper. Those are the ones that I prefer, and if we look at that, we have not even come close to the 61.8%. So, but again, you know, my thought process, just for additional learning, price could continue to drive down and hit our next order block. And look how our imbalance is in view now. Our imbalance is in view because there's that gap that needs to be filled. And like I said, they don't always have to fill them. It's not always a priority. And now I'm going to pause. This order block is mitigated. There's no more order block in that area for us. There was an order block here that as I played it fast, that I missed. So it's when I replay and I miss it, it's like a day where I did not wake up early enough to look at the market. I was doing something else, or I was busy at work and I did not look at the chart, and I look at it as that, and so I missed that trade. That's fine. Furthermore, this is on the upside, so I'm not looking to short trades anyway. So this is just an order block that could be an area. If somebody were to enter long, this could be an area where you at least take partial profits, and so this order block is fulfilled. We will take it out, and I just drew it as an hourly order block. As you know, my order blocks are drawn on the daily. I don't draw order blocks on the hourly. So I just drew it as an example. Some of these are drawn on the hourly just to show you as an example, right? So but my order blocks are always drawn on the daily, and I trade on the daily. But as an example, and anybody who wants to trade these order blocks on the hourly, they're as valid as the daily. You just use a lower time frame as your trigger. So same concept, but these are not my usual entries. But the concept is the same. So even I not using my regular time frame, we can still exercise and go through this together. So that's the purpose. So here we have an order block here. Now this becomes, if we decide to go short or if we decide to go long, this becomes our next area of opportunity to go long. So again, today is not really about showing you examples of entries. Today is about showing you how imbalances occur and how imbalances are fulfilled. So let's draw the next imbalance. We have from this high right there to here. Look how where price came. Price came to a little bit below that 50% and reversed. So imbalances get taken care of. They really get taken care of. And if they're not taken care of, at some point we will see that happening. So we have this imbalance here. We have this imbalance here. And this is based on the current bar replay that is not yet taken care of. But since this one is taken care of, we can just remove it. And again, the purpose is just to show you how imbalances work and how it is easy to identify these imbalances. And as you're trading shorter term, these are imbalances where you can take advantage of for your exits and for maybe very short-term scalping purposes. I don't scalp, so I don't use them for entries. But for scalping purposes, they're also great because you know they will most of the time hit and reverse. So here, this was a good exit. If anybody had gone long for some odd reason down here, this was at least the first sign of exit. So this imbalance is taken care of. We have a new imbalance. We have a new imbalance right there that also just got taken care of. Now here because we are at an area of value, we are at a order block from prior days. Actually, sometimes I get carried away and I forgot to draw these. This order block here is actually this guy here. So as you can see, we took care of this order block, we took care of this imbalance, and if we go to the 15-minute time frame, if we see a break of structure, we have a high, we have a low, kind of a low, and we have a lower low. Because this was closing this imbalance and my longer term outlook is bullish, like I said, I'm not entering short positions. I could now say, because this imbalance is closed on the 15 minutes, if we see a new break of structure, meaning this pullback is over, if I see a sign that we're making a higher high, a higher low, and a higher high, we can enter a position knowing that this order block is taken care of. This order block is taken care of, and because we're trading on an hourly, we don't have an order block because we don't have a new up bar that took price to break new lows. So I don't have any lows broken. So right now, if we have a break of structure in the 15 minutes to the upside, so we have just broken this high. Now I want to see a higher low. If we see, when price does this, again, for me, this is not my comfort zone. I want to see clean up, clean down. It could, and by clean up, I don't mean 1 or 2 bars, I mean consecutive bars, but the way they're going up is clean. They're not, each bar is not almost equal like a spinning tops. And so these I avoid them, but doesn't mean they're bad entries. So here we have a pullback. So this is an okay entry. I mean, I will just show it as an example, but we've already missed it. But I'll show as an example of how this is a 5 pip stop, and we can target our 2. Right now it's 2.28. Did we get stopped out? So maybe my stop was at the wrong place. So stop is right there. So 6 pip stop. I like to go 10 because of spreads. As you can see, this spread is almost 10. So I like to give it at least a 10 spread just to be on the safe side. And I want to make 2 for my risk of 1. So that's my target if I had entered this position. But I didn't see any clean up and down. So because I didn't see any clean up and down, we'll just do this. So now as we just replay it, let's see if we hit our target. This is just, for me, this is not really a clean entry, so we might get stopped out, but that's okay. Let's just switch to 1 hour and play it out. Yeah, we are actually stopped out. This is why I don't like to enter these trades the way I showed it to you here. It's a good example why when I am saying I'm not comfortable, this is usually why I do that. Is when I'm not seeing a clean break of structure, you know, from pullback, it's not a clean break of structure, and we are at the highs here. We've made some double top, we've created liquidity. So there's a lot of things going against this trade. So of course, when we enter, we don't see this liquidity up here. However, what we see is that there's a recent high. There's a recent high here that could be our first sign of trouble. So again, you know, I said it before the replay that I don't like this position. So in any case, the main purpose of this training is where do we identify order blocks, where do we identify imbalances, and how do we take advantage of these imbalances. I don't want to show you charts that I have looked at earlier that are always working, because trading is not about 100% of the time I am right. That's not what trading is about. That's why I like to do these replays together, and as a training and as a teaching moments, because then my thought process, why I'm doing certain things, when we get stopped out, you see it clearly. We get stopped out, and before we even got stopped out, I have said this is not a clear chart for us. So that's why it's important that we look at them. So as an order block, now if we're looking at the hourly, because we're going to trade out of the 15 minutes, because that, again, as I mentioned earlier, this is just as an example on how we can enter them. But I usually use the daily, and then for the order blocks, the daily will show me where my area of value is, and then I use the hourly for that break of structure to enter. So if now price gives us an opportunity to come back to this order block, then so far I'm not seeing any clear indication of imbalance. I'm not seeing any clear indication of price moving one way or another. This is where you have a lot of accumulation, distribution. This is very much sideways action. This is consolidation. Now if price wants to come down to this zone, right? Now price touched here. This is where you now switch to your lower time frame, and now you want to see a break of structure here. You want to see a break of structure. So first you want to see this high broken. If this high is not broken and it wants to go lower, then we will see which high we want to see broken again. See, like clockwork, price comes to order blocks. Once price slices through imbalance, its next stop is the order block. If there was an imbalance, its next stop is the order block. So here we are at the order block, and now we want to see break of structure. What we are seeing is we're not seeing break of structure. We're not seeing any break of structure. So from high to low, we're seeing that. Let's switch into the hourly just to make the view clearer. We're seeing that price has penetrated the 61.8%. That's as it was entering the order block. That's what was happening, and so as a result, there was no break of structure. There was no entry. I'm not even in a hurry to go short. I'm saying my bias is long, but there's this area. This is an interesting area that is showing me some consolidation. This whole area is up and down movement. So it is okay. It is always okay not to enter, not to be in a hurry to enter. This training is not about finding perfect entries as a training purpose. This training is about how do you position yourself when those perfect entries occur, you can pull the trigger. So there are various conditions. There's order block, there's imbalance, there's how much of a pullback we're making, and there's structure. So we have to clearly understand structure. Break of structure of the shorter pullback, shorter rally in the case of a bear market. So we want to take advantage of all of this combined for our entry. So our bias for this case is bullish. So we do not enter any bearish position because it's against our bias. There are plenty of strategies that can take advantage of this bearish movement, and that's not what I am coaching. That's not how I trade. I like to swim with the river. I like to swim downstream. I don't like swimming upstream. And for me, this counter trend trade, wow, tongue twister there. Counter trend trade, okay, I said it again, are not something that I am comfortable doing. I'm not a day trader. This is my supplemental income. This is my long-term retirement income combined. That's how I view as my trading. I don't view it as my primary income. Therefore, I'm not glued to charts all day long. I spend somewhere between 15 minutes to half an hour during the day looking at charts, and I'll spend a couple of hours prior to market opening, and maybe an hour at the end of the day. That's the total how much time I spend looking at charts. That's why I spend my focus on indexes and currencies. And even my currency list, as you can see here, is a short list. I'm not trying to find entry in any currency list. I'm not in a hurry to find an entry. If I don't trade in a single day, it's okay, because my purpose is to capture moves, especially in currencies, to capture big moves over several days. And so as a result, I have a short list. I'm going to spend a limited amount of time, and that's what I'm coaching you. I'm coaching you to spend as little time as possible, not to be a slave to the charts, but let the charts be a slave to you. Let the charts tell you, here's an entry, you can execute. And if there's no entry, you don't execute. And one way you can do that is you set alerts. When you see price coming down to an area of value, in this case an order block, you can say, hey, give me an alert when price reaches here, because that'll be the first sign that we could break structure. And break structure in this case means we make a higher high from these recent highs, we make a higher low, and then we make another higher high. So this area here is where I want to enter. This is what I consider a break of structure entry. This is what you can consider an aggressive entry. So between these two, these are your entries. And less aggressive entry, the aggressive entry low is my stop. The more aggressive entry, the other side of the order block is my stop. So whichever way you decide to control your risk, either way works. But that's how I view as break of structure. If this structure doesn't break, if I'm not at an area of value, I'm not entering. And if I don't see a simple sign of an imbalance, I can wait to exit. If there's an imbalance between where I am and where I want to go, I am at least taking some positions off at that imbalance, because most likely and more times than not, that imbalance will act as resistance, even if it's momentarily. But not knowing how deep that imbalance will push price against me, I will take a good portion of my positions out at that imbalance. So you've seen how the imbalances are drawn. You've seen how the order blocks are drawn. You understand supply zone, demand zone, and you understand break of structure. Break of structure of the long term and break of structure of the short term. So because I trade the daily and hourly, my long-term break of structure is looking at the daily. So when I look at Canadian dollar versus Japanese yen, we're in an uptrend while moving, in a range and slowly grinding up. So this uptrend is what I want to respect for my entry, and then I'll use the hourly to pinpoint for that precision. Because my stops, I don't want anything greater than 50 pips. If I'm at 50 pips, I'm already nervous. I'm already nervous because that's a lot of pips for me. That's $500 on a standard lot, right? 50 pips. And so, I want to be able to enter and exit positions in batches. So I want to take off 50% of my position at first area of travel, or 2 to 1, and then take more positions along the way. So to do that, I have to take more than one lot, and you don't have to take a standard lot. You can do as small as a nano lot, but you should be able to take multiple lots so that you can exit at different targets. This is what makes this a beautiful system. You have multiple targets that you go for. So understand your structure, and then use the order blocks as your area of value. Use the imbalances as your area for exit, and exit 1 or exit 2 depending on where you are. And once those imbalances are taken care of, you remove them from your chart and draw the next imbalance. Makes it very, very easy to keep doing this. So I see an imbalance here. I see an imbalance here, just to show you an example. So on November 30th, price made just kept going up, but from November 27th, price didn't come down, right? It didn't fill those gaps. Price just kept going up, and then we have this. So this is not a good example because this bar went up and down. So you might say there's no gap there. It got taken care of. Whether you treat it that way or not, it doesn't matter, because then you see a couple days later we came back to that 50% and reversed. So that those imbalances are taken care of. If you draw them wrong, it's okay, because they never get taken care of, right? If they're already taken care of and you had them wrong, then that's okay, because price will never come there. So you see an imbalance here. You see an imbalance here, and price didn't come to 50% of that imbalance, but it came back to some degree in that imbalance. So you might want to leave this one as an example for future reference. So I know this has been a long video, but the purpose of this video was really to add to your tool set. Here is an additional thing you can look at: understanding imbalances to add to order blocks, demand zone, supply zone, and liquidity. Liquidity meaning when we have double tops, double bottoms, triple tops, triple bottoms. Understanding that price gets manipulated at those levels, and when price is manipulated, you don't want to get caught on the wrong side, and both sides is the wrong side until the manipulation is over. So when you see price coming to an area of support and resistance, wait to see what price does to take care of that liquidity. Once they take care of the liquidity, once they take short sides out, long sides out, the new entries at that moment, they're golden. You have very, very tight stops, you have beautiful entries, and you just take price where you want it to go. All right, everyone. I'm glad you spent this hour with me. I want to request that you like this video so I know you've had a chance to listen to it and been able to take advantage of this learning, and it will keep helping me do more videos. So take care everyone.